Welcome to today's video, where we're diving deep into the world of AI-powered investing. I recently challenged some of the most advanced AI models to create the perfect investment portfolio, and the results were absolutely mind-blowing. Get ready to see if artificial intelligence is about to revolutionize finance, or if it's just another overhyped trend. For this experiment, I used ChatGPT-4, one of the most sophisticated language models available. I gave it a clear directive: create a diversified investment portfolio for an aggressive risk profile with maximum returns. I specified that the portfolio should include stocks, cryptocurrencies, real estate, and alternative investments. To make things interesting, I set a 10-year time horizon and asked for inflation-adjusted returns. Now let's break down what the AI came up with. Brace yourselves, because some of these picks are wild. Starting with stocks, the AI didn't just stick to safe ETFs like VOO. It went all in on individual stocks, allocating a significant portion to tech giants like Nvidia and emerging AI companies. For cryptocurrencies, it didn't just recommend Bitcoin. The AI suggested a mix of established coins and some lesser-known altcoins that it claimed had high growth potential. In the real estate sector, the AI didn't limit itself to REITs. It proposed a combination of high-yield commercial property investments and residential real estate in up-and-coming markets. But here's where it gets really interesting. The AI included some truly unexpected alternative investments. We're talking about things like fine art, rare whiskey collections, and even carbon credit futures. Let's take a closer look at the percentage allocations. The AI created a pie chart that would make most traditional financial advisors do a double take. 40% in stocks with a heavy tech bias, 25% in cryptocurrencies, split between established coins and speculative plays, 20% in real estate, both traditional and tokenized, and a whopping 15% in alternative investments that most people have never even considered. Now, before we dismiss this as complete madness, let's consider some potential pros of this AI-generated portfolio. First and foremost, it's undeniably diverse. The AI has spread risk across multiple asset classes and within those classes. It's also leveraging massive amounts of historical data to make these decisions, potentially identifying trends that human investors might miss. And perhaps most importantly, it's completely free from emotional bias. There's no fear, greed, or FOMO influencing these picks. But let's not get carried away. There are some serious red flags we need to address. The most glaring issue is potential overfitting. Just because something performed well in the past doesn't guarantee future success. The AI might be putting too much weight on recent trends without considering long-term economic cycles. Another major concern is the lack of personalization. This portfolio doesn't take into account individual factors like tax situations, age, or specific financial goals. And let's talk about that crypto allocation. 25% is extremely aggressive, especially considering some of the speculative coins included. Perhaps most worryingly, the AI seems to be ignoring major macroeconomic factors. There's no consideration for potential recessions, geopolitical risks, or regulatory changes that could dramatically impact these investments. To get a professional perspective, I showed this portfolio to a certified financial planner. Their reaction? A mix of fascination and concern. They praised the innovative thinking, but warned that this level of risk would be unsuitable for most investors. They also pointed out that the lack of bonds or other stabilizing assets could lead to extreme volatility. I didn't stop there. I used Portfolio Visualizer to backtest this AI-generated portfolio against a traditional 60-40 stock-bond split and the S&P 500. The results were interesting. In bull markets, the AI portfolio significantly outperformed. But during downturns, it experienced much steeper losses. Over a 10-year simulated period, it did beat the market, but with heart-stopping volatility along the way. So, what's the final verdict? Would this AI-generated portfolio actually work? In the short term, it could potentially deliver explosive growth. But it's also a recipe for sleepless nights and potential financial ruin if the timing is wrong. Long term, the jury is still out. We simply don't have enough data on how these AI models perform over decades of market cycles. Who should consider using AI for portfolio construction? It's definitely not for beginners. The level of risk and complexity here requires a deep understanding of financial markets. However, for experienced investors looking to challenge their assumptions and explore new ideas, AI could be a valuable brainstorming tool. If I were to tweak this portfolio, I'd make some significant changes. First, I'd drastically reduce the crypto allocation to no more than 5 to 10% of the total portfolio. I'd introduce some bonds or other fixed income investments for stability, and I'd be much more selective with the alternative investments, focusing on those with a proven track record rather than speculative plays. Before we wrap up, I want to hear from you. Are you curious about how AI would build a portfolio for your specific risk tolerance? Drop a comment below with your risk profile, conservative, moderate, or aggressive, and I might feature it in a future video. If you found this AI versus finance experiment interesting, make sure to hit that subscribe button. We'll be diving into more cutting-edge topics at the intersection of technology and investing in the coming weeks. Remember, while AI can provide fascinating insights, it's not a substitute for professional financial advice. Always do your own research and consult with qualified experts before making major investment decisions. Thanks for watching, and I'll see you in the next video.